REBO exam preparation. Core concepts, regulations, and insurance principles. REBO important concept part 3, or indemnity contract. A pure indemnity contract is a specific type of legal and insurance agreement where one party, the indemnifier, promises to compensate another party, the indemnified, for the exact amount of actual financial loss they suffer, no more, no less. The core philosophy of a pure indemnity contract is restoration, not enrichment. The goal is to place the affected party back into the exact financial position they were in right before the loss occurred. Here is a breakdown of how it works, its key principles, and how it differs from other contracts. Key principles of pure indemnity. For a contract to be considered one of pure indemnity, it must adhere to several strict legal doctrines. The principle of indemnity: you cannot profit from a loss. If your $500 phone is stolen, the contract will only pay you $500. Replace the phone, even if your policy limit is $1,000. Insurable interest: you must have a financial stake in the subject matter. You cannot take out an indemnity contract on a neighbor's house because you wouldn't suffer a direct financial loss if it burned down. Subrogation: once the indemnifier pays you for your loss, they inherit your legal rights to pursue any third party who caused that damage. If someone crashes into your car and your insurer pays to fix it, the insurer can sue the at-fault driver to recover that money. Contribution: if you accidentally insure the same item with two different companies, you cannot collect the full amount from both. The two insurers will split the cost of the actual loss. Common examples. Most forms of property and casualty insurance are pure indemnity contracts. Homeowners insurance: if a fire damages your kitchen, the insurer pays the actual cost to repair the kitchen. Car insurance, comprehensive collision, pays for the actual cost of repairs or the actual cash value of the vehicle if it is totaled. Commercial liability insurance covers the exact amount of legal fees or damages awarded if your business is sued by a third party. What is not a pure indemnity contract? To understand pure indemnity, it helps to look at what it isn't. The main contrasts are contingent contracts and valued contracts. Life insurance contingent contract. Life insurance is not a contract of indemnity. You cannot put a precise dollar value on a human life. Instead, it is a contingent contract. The insurer agrees to pay a specific, predetermined sum, e.g., $500,000 upon the occurrence of an event, death regardless of any actual financial loss. 2. Valued policies. Some marine or high-end art insurance policies are valued policies. If you insure a rare painting agreed by both parties to be worth $1 million, and it is destroyed, the insurer pays the $1 million. They do not calculate market fluctuations or depreciation at the time of the loss. They pay the agreed face value. Impacts with wild animals or birds are handled under the comprehensive coverage section of your auto insurance policy, often listed under loss or damage options. Even though you technically collide with the animal, insurance companies classify it as a comprehensive claim because wildlife is considered an unpredictable external hazard that is completely out of your control. Why the distinction matters? Because it falls under comprehensive rather than collision coverage, it is treated differently during the claims process. Not at fault. Hitting a live animal running across the road is virtually always classified as a not at fault accident. This means filing a claim under your comprehensive coverage will typically not cause your insurance premiums to increase. The deductible: you will still have to pay your comprehensive deductible, e.g., $500 or $1,000 to get your vehicle repaired, while your insurer covers the rest. The one major exception: swerving. The classification entirely depends on what your vehicle actually makes contact with. Direct impact: if a deer leaps in front of you and you hit the deer, it is a comprehensive claim, not at fault. Swerving to miss: If you swerve to avoid a bird or a deer, miss the animal entirely, and instead hit a guardrail, a tree, or a ditch, it becomes a collision claim. Because you hit a stationary object, the insurance company will deem it an at-fault collision, which can cause your premiums to go up. Similarly, if the animal is already dead on the road and you run over it, insurers usually classify that as hitting a stationary object on the tarmac, processing it under collision coverage as an at-fault incident. Ontario Policy Change Forms. In Ontario Auto Insurance, OPCF stands for Ontario Policy Change Form. These are standardized endorsements used to modify, add, or restrict coverage on the Standard Ontario Automobile Policy, OP1. While letters like E, F, G, and H are sometimes used as shorthand subcategories by specific insurance companies for internal packaging or legacy rating systems. For instance, rating tiers are specific policy sections. The actual regulatory forms governed by the Financial Services Regulatory Authority of Ontario, FSRA, are designated strictly by numbers, because E, F, G, H often correspond to the numbered endorsements relating to commercial, fleet, special uses like passenger transportation and altering policy exclusions. Here is what those key lettered categories translate to in the standard numbered OPCF system. 1. Passenger Transportation Public Use, the 6 Series. If you are looking at forms grouped under a public vehicle or passenger category, often loosely categorized under letters like F or G in old commercial rulebooks, these dictate how a vehicle carries people for money. OPCF 6A, permission to carry paying passengers, essential for taxicabs, rideshare drivers, or carpooling schemes that exceed standard carpool limits. It grants permission to use the vehicle for compensation. OPCF 6B, school bus endorsement, specifically modifies the policy to permit carrying passengers for school-related purposes. OPCF 6C, public passenger vehicles, used for public transit buses or commercial sightseeing vehicles, outlining specific higher limits of liability. OPCF 6F, public passenger vehicles, combined limits, often used for commercial operations to combine liability limits into a single payout structure. 2. Commercial and fleet operations, the 21 and 27B series. Commercial are fleet risks, frequently grouped in broker books under commercial sections like E or F, modify standard personal restrictions. OPCF 21A, monthly reporting basis fleet, used for commercial fleets where vehicles are leased for more than 30 days, requiring monthly statements of mileage or receipts. OPCF 21B, blanket fleet coverage, automatically covers a changing fleet of Ontario licensed vehicles under one blanket policy. OPCF 27B, business operations, non-owned vehicles, extends liability and physical damage coverage to commercial vehicles or rental trucks driven for business purposes, lifting the standard personal weight restrictions, 4,500 kg. 3. Hazard permissive restrictions, the 4 series. If the letters refer to hauling specific high-risk cargo, traditionally isolated to specialized commercial sections. OPCF 4A, permission to carry explosives, overrides the standard policy exclusion that automatically voids insurance if you carry explosive cargo. OPCF 4B, permission to carry radioactive material, explicitly amends the policy to allow the transport of specified nuclear or radioactive material. Slide 4. Marine exclusions, OPCF 9, sometimes grouped under specialized recreation brackets. OPCF 9, marine use excluded, a restrictive endorsement stating the insurer will not pay for any loss or damage occurring while an amphibious or specialized vehicle is on water or during the launching landing process. Electric light bulb, note on policy tracking. Because insurance companies occasionally bundle proprietary benefits, like a specific gold or elite package using arbitrary letter codes on your policy summary sheet, it is highly recommended to check the certificate of automobile insurance. Look for the actual numbered form, e.g. OPCF 20, OPCF 27, OPCF 44R, to know exactly what legal endorsement is applied to your policy